Okay, let's do some questions here. Montau AG is a German capital goods producer that manufactures its products domestically and delivers its products to clients globally. Montau's global sales manager shares the following draft commercial contract with his treasury team. We have a contract date, we have the identification of the seller, the identification of the buyer, and a description of what is being delivered, the quantity that's being delivered, the delivery terms, the delivery date, 75 days from now, the payment terms, and a contract price. So we have an expiration date, 75 days from today. We have a contract price. And we have the two counterparties. This is, by the way, a forward agreement. This is a forward contract. Montau AG's treasury manager is tasked with addressing the financial risk of this prospective transaction. So where is the financial risk in this transaction? Can you identify it? The seller is in Germany. The contract price is in Korean won, and it's 75 days from now. So here we are. Here's 75 days from now. Well, there's going to be an exchange rate between the Korean won and the euro. That may not be the same on this date. So when you get your Korean won and you transfer it into euro, you might end up with more euro or less euro than on the day that you quoted. You know what? Based on the exchange rate, let's say it's going to cost us 100, well, whatever. I don't know what the exchange rate is between Korean won and euro, so I'm not going to give some example. But let's say that it costs X euro, and we multiply it by the exchange rate. And that equals 650 million Korean won. Well, what if the exchange rate changes and you end up getting less than X euro? You get X minus an amount Y. Well, you don't want that, right? So the financial risk lies right here. Let's look at the questions now. Which of the following statements best describes why Montau AG should consider a derivative rather than a spot market transaction to manage the financial risk of this commercial contract? Montau is selling a machine at a contract price in Korean won and incurs costs based in euro. Yeah, but so what, right? I mean, what would it matter? That's not where the financial risk lies. The financial risk lies in the rate at which this can be exchanged, not the fact that your selling price and your costs are in different currencies. B, Montau AG faces a 75-day timing difference between the commercial contract date and the delivery date when Montau AG is paid for the machine in KWR. That is a big one right there. Because you have this 75-day timing difference, you don't know what the exchange rate is going to be. You have currency risk. So there's a good reason. C, Montau AG is unable to sell Korean won today in order to offset the contract price of machinery delivered in the future. Well, they're not going to get paid till sometime in the future. So that's just a true statement. They cannot sell the Korean won today. They don't have the Korean won. So even if you entered into a derivative contract, you still couldn't sell Korean won today. It's only in the future. So we will enter into a contract today with either, typically for this is you have your contract with your customer, and in 75 days, you know you're getting 650 million Korean won. You will enter into a forward agreement with a financial institution that says, I want euros and I will give you 650 million Korean won in the future, and you'll agree on an exchange rate today. And then when this comes in the future, you've already locked in your exchange rate. So because we have a timing difference to the receipt of the foreign money we'll be receiving, we would like to hedge that out by agreeing on an exchange rate today. Which of the following types of derivative and underlyings are best suited to hedge Montau's financial risk under the commercial transaction? Well, we know the underlying has to be an exchange rate. So we just have to figure out the type of derivative. Remember, there are two broad types of derivatives, right? Commitments, in which both parties are obligated, and contingencies in which one party has a right. Montauk AG should consider a firm commitment derivative with currency as the underlying, specifically the sale of Korean won at a fixed euro price. This is right, because Montauk is going to be receiving Korean won, so it's going to want to sell those Korean won and get euros in return. It's a firm commitment, so it wants to make sure that that's going to happen because it is going to get these. It doesn't want those, it wants these. And it doesn't want the other side to say, you know what, we've changed our mind. We want a firm commitment. A is correct. Montauk AG should consider a contingent claim derivative with the price of the machine as its underlying, specifically an A-series laser cutting machine. Well, we don't want that. We are actually selling the machine and getting, we're in the business of selling it, so we have a contract to sell it. We already have a contract to sell it, but we're getting Korean won. There, we don't have a contract on the exchange rate, so our underlying is not the machine. Get rid of that. Montauk AG should consider a contingent claim derivative with currency as the underlying. Well, currency is true, specifically the sale of euro at a fixed Korean won price. But we're not going to be selling euro. Selling euro means we get rid of euro and we take in Korean won. We're getting Korean won already. We don't want more of it, so we can get rid of this altogether because this is the wrong thing. Now it says a contingent claim. Another way of thinking about this is why not just have an option on the currency exchange such that if the currency over that period of time worked in such a way that 650 million Korean won bought more euro than you wanted, then you win. But if it bought less, then you have the right to make somebody pay the price. You could, but that's going to cost money to get done because you have to pay for that right. Options have a cost. Forwards and futures are free. The second part of that is once you start getting into that, you are now speculating on the currency. Is this company in business to sell machines or is it in business to speculate on the currency? If it's in business to sell machines, then it should hedge currency risk so that all of its profits are based on the operations it's set up to do, which is make machines, as opposed to speculate on the direction of the currency. Because on a contingent claim, if it was wrong, it's out the premium that it paid to make that bet. Identify A, B, and C in the correct order in the following diagram, as in Exhibit 1 for the derivative to hedge Montauk's financial risk. Remember, their financial risk is the currency. And once they enter into that contract for the delivery of the laser, they would then go to their bank and say, okay, listen, I need you to enter into a contract with me for the exchange of these amounts in the future. So A is definitely going to be a financial intermediary. That takes out B. Montauk here, C, must be delivering the Korean won to the bank because what do they want in the end? They want euro. So B must be euro and C must be Korean won. There we are. Which of the following statements about the most appropriate derivative market to hedge Montauk AG's financial risk under the commercial contract is most accurate? What do we need? We need a contract for 650 million won in 75 days. The OTC market is the most appropriate for Montauk as it is able to customize the contract to match its desired risk exposure profile. Yep. The exchange traded derivative market, ETD, is most appropriate for Montauk as it offers a standardized and transparent contract to match its desired risk exposure. We don't know if that's true. Nowhere in there is it said anything about whether or not that's true, but we could just think this through. This is a very specific amount in a very specific number of days. Standardized contracts are typically, the underlying is typically for 100,000 of whatever it happens to be in currencies. You wouldn't know that, but it is. So this isn't quite standard, and you're not going to find exactly 75 days because exchange traded derivatives typically expire on a specific day of the month. And you can get close, but not quite. So on this one, we want OTC. This is ETD. This is ETD. We can get rid of that, which also gets rid of this, because if this said ETD or, well, that the or part is true. It's one or the other. This part, it would be a true statement, but it's an and. So it's saying, well, you can go to both. You can't. OTC only